So let's talk about teaching your children about investing. Welcome back to another episode in this series on Black wealth that we're doing for Black History Month. Today's episode, teaching your children about investing, teaching your children about the stock market. We have to admit, myself included, that we were never taught about the stock market. We were never taught about the stock market. Mom and dad, no one really taught me. The only exposure I had, thinking back, was in high school. We had a substitute teacher once who had us buy the newspaper every day for a week, look up and follow a stock. And I found it so interesting because normally nobody around me, nobody in my circle talk about stock, talk about the stock market. I found that so interesting, but it was never followed up at home. It was never followed up with anybody. So I just, you know, did what people in my circles did. So we'll do the middle school who, what, where, how, and why to learn about the stock market. First, we'll start with is who. Who should invest? Everyone should invest. Everyone should invest, from the kid in preschool, because they can have a custodial account, as I've talked about before, and you want to get them started early, to the senior citizen who's older, to the hey. So everybody should invest, from the little baby who was just born, right? The parents could get a custodial brokerage account, like that little girl we just passed, right? Her parents could get her little brokerage account. Um, the teenager, the adult, the senior citizen, we should all be investing. In the Black community, we should all be investing. Okay? Everyone should be investing. All of us should be investing. So that's the who. Who? All of us should be investing. Okay? When they come around Thanksgiving, they should all be talking about it, right? From the little kids at the little junior table to the adults, everybody should be talking about what they're investing in. That's how you educate yourself. So now that we got out of the way that everyone should be investing, let's talk about what. What is investing? Investing is taking dollars from today, putting it in an investment vehicle called investment, so it will grow and be worth a lot more in the future. That's what it is. It's, in the simplest form, taking dollars from today, putting it in a vehicle, an investment vehicle, so it can grow and be worth a lot more in time to come. That's what investment is. You may say, what types of vehicles can we put it in? Well, we can put it in stocks, which are ownership in individual companies. And then with that, you can begin to talk to them about single stock risk, but there's a potential for reward as well, versus diversification, put it in groups of stocks, such as an ETF, or an index fund. We can talk about actively managed funds where there is a fund manager, there'll be a higher cost, and there's no guaranteed that you'll get a higher return, even though that's what they promise, versus a passively managed portfolio, such as an index fund that follows or tries to mimic or mirror an index, such as the S&P 500 or the Dow Jones or the NASDAQ 100, right? Lower fees, the returns are better, and this is what Warren Buffett recommends. Okay, so there are other vehicles too. There are bonds, right? Which is basically an IOU. So you can loan money to a company or a corporation. It's called a corporate bond. Usually you'll get a higher return. You can lend money to a municipality called a muni bond or a municipal bond. So you could loan money to maybe New York City or to Baltimore, and they will give you a return, right? These are the vehicles, or these are the what of investing. They'll tell you how much return you'll get, how long your money will be tied up for, and usually those municipal bonds have 0%. Usually they're tax free. Right? So this is some of the what of investing. You can invest in REITs, real estate investment trust. You're not a direct owner of real estate, but you're investing in a company that holds real estate. So these are some of the things that we can invest in. Now, that is the what of investing, right? That's what investing is. Putting today's money in an investment vehicle, so it'll be worth a lot more through the process of compound interest in the future. Mm-hmm. Why? We did who, what, why. Why should you invest? Good question. I'm glad that you asked. Why should I invest? Well, you should invest because of inflation. What is inflation? Inflation, as we've been in the last couple of years, you probably already know, everything cost more during inflation. Your gas costs more, your food costs more, your rent costs more. This is inflation, right? The money costs more, so the cost of borrowing money it goes up, right? When the inflation rate goes up. So to bring it home, your spending power gets weaker. Your spending power gets weaker. Your money is worth less. So to bring it home, because of inflation, $100 would only buy $98 worth of goods and services the following year, 2% less. It's the same $100, it just buys less, 2% lower buying power. The year after, the $98 will probably only buy about $96 worth of goods and services. The inflation is the reason why your grandparents will tell you, back in my day, I was able to buy our home for $12,000 in 1945. But when you convert it, that $12,000 in 1945 had the buying power of a lot more. Okay, so why should we invest? One of the main reasons we should invest is inflation. Okay, because you take your $100 and put it under your mattress, in 2 years, it's still $100, but it won't be able to buy $100 worth of goods and services. Okay, but when you invest, and if your investment is growing at or above inflation, you'll be able to keep up and potentially move ahead, right? If your investments are growing at 10%, your $100 is now worth $110. So even with inflation, you remove 2%, it's still worth $106. So you did better by investing it than putting it under your mattress. So why should we invest? We should invest because of inflation. What are the reasons we should also invest? Another reason why we should invest? We should invest to give us options. What do you mean? Well, without investments, you will only have income from your job. Let me repeat that. If you never invest, the only income you're going to have is your active income. So you want to tell your children you want to invest So you want to invest so you can beat inflation. And number two, you want to invest so you can have options in the future. You want to have income coming in from other sources besides your job. Who, what, why, where? Where should you invest? Another good question. I'm glad you asked that one too. Where should you invest? Well, now this gives you an opportunity to talk to your children about different accounts. Growing up, we always heard about savings account. We would often hear about checking account. Mom and dad had checking account, right? The savings account is where you save your money. So the savings account is where you save your money so you can have money for the future. But we know that the rate of return in the savings account is not that great. It's a little better with high yield savings account, but not as good as in the stock market. And you don't own any shares of the company. The other thing too is that the interest, even in the interest in the savings account and in the high yield account, is simple interest. Again, this gives you an opportunity to talk to your children about the difference between simple interest and compound interest. So, the interest in a savings account is simple interest, right? And the interest in stock portfolio. So the interest in a savings account is simple interest, which basically means if you have $100, basically the interest in a savings account is simple interest, which basically means if you have $100 in a savings account and you're getting 2% interest, the next day you're going to have. So the interest in a savings account is basically simple interest, which basically means if you have $100 in your savings account and they're giving you 5% return, it basically means that you'll have $105 the next at the end of the year, right? So if you have $100 in your savings account and they're giving you 5% interest, the next year you're going to have $105. Year two, they'll give you another 5% based on the principal, then you'll have 110. Notice the $5, which is the interest from year one, did not get its own interest. Only the principal gets interest. That is simple interest, as opposed to when you have a stock, right, or an ETF. Not only does the principal get interest, but the interest earns its own interest. In that example, you have $100 in a stock portfolio and getting 5% return. After year one, you'll have $105. After year two, you'll have another $5 from the $100 principal, but the $5 will also get its own 5% return. All right, in that example, I think that'll be about 25 cents. But after a short period of time, it doesn't seem like it makes a big deal. But after many years and with larger sums, it makes a big deal. So, who, what, why? So, where should you invest? You invest in a brokerage account. You invest in a brokerage account, right? Growing up, a lot of us heard about savings account. We heard about checking account, but not a lot of us heard about brokerage account. I know I didn't really hear about brokerage account and really know the intricacies and the ins and outs of what it was. I knew what a savings account was. I heard about it. I knew what a checking account was. Mom had a checking account and you had to write checks and stuff for the rent. But nobody even told me about a brokerage account, what a brokerage account is. And sometimes, like that, these things seem simple, but it might as well have been from Mars, right? It might as well have been from Mars, because when you're not in that circle, people are not going to talk to you about it. You're not going to know about it, and you're not going to benefit from it simply because you're not in that circle, right? They say you are the average of the 5 closest people to you. So if you know no one with brokerage account who are actively investing, who are trying to build wealth, you're simply not gonna know about it, right? So where do you invest? You invest in a brokerage account, and you will teach that to your children. There's different types of brokerage account. You can have an individual brokerage account. You could have a joint brokerage account between two people, most commonly with husband and wife. You could have a custodial brokerage account for minors. That's why when I said who should invest, everyone should invest. Minors, your baby who's 1 week old, as long as you have the social security, the date of birth, address, all that stuff, you can open a brokerage account for your minor child. Who, what, where, how? How do you invest? Well, we said you invest in a brokerage account. So your investment is held within a specific account, right? It's going to be in a brokerage account, whether it's individual, whether it's joint, whether it's custodial. That's, you know, that depends on, right? So your investment is in a brokerage account. Your investment is in a brokerage account, okay? Whether it's a joint or individual or custodial, that's fine. And that varies, right? Your investment could also be in a taxable or a not. Your investment can also be in a taxable account, which means it's not a retirement, or it could be in a qualified account, such as a retirement account, right? So what's in your your investment? So that's the account. The investment is what's in it. What's in it could be stocks. You could have investment in stocks. You could have money invested in Apple stock, or in Home Depot stock, or in Walmart stock, or in McDonald's stock, or in a bond, or in a bond ETF, or in a stock ETF, or in an index fund, right? You could have that. And let's go back to the brokerage. You can choose lots of different brokerage. You can choose some of the traditional, such as Vanguard, right? Vanguard is a very large brokerage. You could choose Fidelity. You can choose Schwab, who just bought out. You can choose Schwab, who just bought out TD Ameritrade. You can choose Schwab, who just bought out TD Ameritrade. You can choose E-Trade, or you can choose some of the new online only. You have Robinhood, you got M1. So you have your choices of brokerage, okay? And what's in it is your investments. So you could have stocks, bonds, ETFs, right? And you basically fund your account. You have to put money into the investments. So whether it's $100 every paycheck, or whether it's $200, or whether it's $300, you keep putting money in there. And when you get a raise, you put more money in. And when you get the return, or the growth, the 10% growth or the 15% growth, then you put more money in. And one key thing to remember, there's going to be fluctuations in your portfolio. The stock market is going to go up and down, right? Whenever you look at the stock chart, you see up and down. You see these little up and down. The gradual tendency is to go all the way up, right? You look at the 5-year chart or the 10-year chart. The trend that you'll see is the growth. The trend that you'll see is the growth. That the stock market grows over time. Annualized, the S&P 500 grows about 10% per year. It's not 10% every year, but annualized, meaning if you take all the ups and downs and peaks and valleys and divide it over time, you see it grows about 10% every year. For example, in 2023, last year, the stock market grew, the S&P 500, which is referred to as the stock market, grew 24%. So if you had $100,000 in there on January 1st, 2023, at the end of the year, December 31st, 2023, that 100,000 would have grown 24% to $124,000 without you doing anything. But it's not always going to be like that, right? The year before, I believe, the market was going to be down. So the market may be down 1 year, 10%, maybe down another year, 5%. 1 year, it may be flat. The next year may be up. But net, meaning when you take everything up and divide it, meaning when you take all the ups and downs and you divide it over time, it has grown by about 10% every year. Okay? So you have to teach your children that there's going to be ups and there's going to be downs. Do not, I repeat, do not sell when the market is down. Do not sell when the market is down. The ups and downs are what they call unrealized gains and losses, meaning the going back to that theoretical 100% portfolio that went up 24%, yeah, their portfolio grew 24% or $24,000, but they don't have that $24,000. They would only get the $24,000 if they sell their stock. Just like the losses are also unrealized, meaning you only really truly lose money if you sell, right? When they said when you sell, that's when you quote unquote you have locked in your losses. As long as you don't sell, it's all theoretical. Okay? So when the market is down, what you have is an opportunity. For what? When the market is down, you have an opportunity to buy stocks on a discount. You want to teach that to your children. When the market is down, it's a great opportunity to buy stocks on discount. So, think about it. Think about when the store has a sale. When the store has a sale and it's 50% off, you don't say, "Oh my goodness, oh my goodness." No, you said, "Load up the basket." All these jeans and shirts and sneakers and that were $100 are now $50. But when stocks go on sale, people freak out. So you want to be able to control your emotion, and you want to teach that to your children. You want to teach that to your children, okay? That do not sell when the market is down. Keep buying, keep buying, keep buying. Because what you're doing is you're getting stuff on sale, right? The stocks that maybe, say for example, was $100 are now maybe only $50. So now you can get twice as much stock for the same price. Keep buying when the market is down, okay? Keep buying when the market is down. Just remember that over time, the market has always came back up. The market was down during COVID, and now it came back with a vengeance. The S&P 500 is now nearing the 5,000 mark. Okay? So guys, it is important for us to teach. So guys, it's important for us to teach our children these things at a young age. If I would have known this in 2008, not to sell when the market is down, what to invest in, I'd be in such a better position. I sold everything. But you don't have to make the mistake I did, and our children don't have to make the mistake that we did by waiting too late to invest, or being scared of the market, or selling when it is low. So it is our responsibility to educate our children about the stock market, and I'm doing my part by educating my viewers. It is our responsibility to educate our children about the stock market. Let me repeat that. It is our responsibility to educate our children about the stock market. Because if we don't do it, nobody else will. If we don't do it, nobody else is going to educate them. So we have to take that responsibility serious so they can reap the benefit. They say, "Thank you, Mom. Thank you, Dad." The market is not going to be intimidating to them. They're going to know what to buy, how to buy it, when not to sell, how to hold, right? How to hold, and they're going to benefit. So again, the MD Investor was another video so we can educate ourselves and our children and break the cycle of generational poverty. Don't forget to subscribe on YouTube. MD Investor out. So Another thing we want to remember in terms of how we invest, we basically have to link a checking account to our brokerage account. You link a checking account to a brokerage account, and they'll get to all the details, and they'll ask you all that detail when you're filling out the application. Okay, the account number, the routing number, what type of account is it, and then you transfer money from your checking account to the brokerage account. Mm-hmm. You transfer money from the checking account to the brokerage account. I believe you can also use a savings account too. I think you can link a savings account as well. Then you transfer $100 or whatever to the account. Mm-hmm. They may, and they'll check to make sure the account is valid and so on. Sometimes they'll send you like a micro deposit, and you have to confirm, you received it, and then you, can start investing. So you'll send, you transfer $100 from your checking account or from your linked account to the brokerage account, and then there'll be $100 there, and then you'll be able to buy your stocks or your ETFs, and you'll see, you'll see the request, you'll see the confirmation, whether you bought 1 share or 2 share, and then you'll see it in your account. You'll see the ticker symbol, how many shares you have, and when those companies or ETFs pays a dividend, you'll see the dividend amount. And then they'll ask you, do you want your dividends to be in cash, meaning they send it to the account, or do you want to be reinvested? I would say reinvest. Put automatic reinvestment. And the other thing you can do too is to have some type of a automatic investment setup. So every time you get paid, you may say every time you get paid, you may want to transfer $100 or $200 or whatever you want to set up, and then begin to buy stocks, buy ETF, buy stock, buy ETF. You're buying assets that will grow in value, and that will also give a dividend, right? And this is how you begin to grow your wealth. Giving this knowledge to your children at a young age is an awesome thing. Okay? Giving this knowledge to your children at a young age is an awesome thing.